So sovereign curve, as we can see, it continues to steepen. Uh, but at some point of time, as the rate hike cycle starts, we do expect the curve to flatten. Typically, in rate hike cycles or tightening cycles, typically the short end tends to go up, and that is what we expect probably next year when the policy cycle unwinds. That is where curve should behave. This is the broad movement of how whether it was GSEC, AAA papers, or credit spreads moved in the month of April. So, for example, if you look at most of the curve yields went up on the long end. So, if you see, for example, 3-year AAA remained at 734 flat. Similarly, compared to March 26. If you look at 5-year AAA, that also remained flat. But if you look at the 10-year AAA, that moved from 742 to 755. So that was the steepening that we were talking about in the previous slide as well, that while the short to medium end has remained stable, the longer end has started to move up, especially on the corporate bond side. If you look at AA papers also, if you look at 5-year AA, it remained largely stable. But if you look at 10-year AA, again it moved up by almost 10 basis. So that's the steepening which is happening on the between the 5 and 10 year space. So broadly on our outlook, uh, you know, too many things happening. There is West Asia conflict, higher oil prices, logistical disruption, and of course potential El Nino risk that we talked about. But do they mean only one thing? Do they mean only inflation? No. They also mean slowdown in economic activity, and hence it also means upside risk to inflation, but it also means downside risk to growth. So probably RBI will remain in a wait and watch mode. They will try to see what's the exact damage to inflation and growth, and hence they will take a call. If you remember last year, throughout the last year, inflation was close to 2%. But RBI did not cut rates beyond a point. They remained at 5 quarter. Just like they did not cut last year when inflation was below 4%, there is a possibility that they may wait it out for some time till they see inflation meaningfully close to 6%. So even in the near term, inflation goes over 4%, probably close to 5% in next 2-3 months as the impact of higher oil prices may start to show through. But nevertheless, we expect them to wait it out to see what's the impact on growth as well, and hence take a call accordingly. So inflation, like I said, will rise from current levels. It will start moving towards 5.5, but probably RBI is not likely to hike immediately because largely these pickup in inflation reflect base effect, higher energy prices, and supply side pressure just demand demand overrated. So it's not really coming from higher demand; it's coming from largely supply side shock. And typically, what we have seen is, and it's happening globally, monetary policy typically looks through the first round supply side shocks. So just like we saw Fed last year when tariffs were announced in the US, it was seen as a supply side shock, and only there is a strong evidence of second round impact of those supply side shocks, whether in terms of price pass through, wage pressures, or unanchoring of inflation expectation, which broadly means that outflow from fixed income towards more of gold and real estate, where typically people buy real assets rather than financial assets. That is when a central bank tend to think that probably there is some second round impact and I need to address it. But I think at least in the next 3 to 6 months, RBI is likely to stay put. But if you look at liquidity management will remain proactive. And if you look at current liquidity also, like we saw in the chart, it's almost at 2.5 lakh crores. On top of it, we are likely to see a dividend of 2.5 to 2.8 lakh crores. So we are potentially looking at a liquidity of 5 lakh crores almost, and it's expected to remain positive for the next 6 to 12 months. And hence, we think that the front end of the curve remains the most preferred segment because we are not taking a view on the rate action because, like I said, there's a two-sided view. But if you look at the liquidity, there is a clear visibility that liquidity will remain ample. And typically in these periods where there's uncertainty on interest rates, but liquidity is visible, usually the front end of the curve tends to outperform. And that is why we think that investors who have a 3 to 12-month investment horizon can consider money market or low duration strategies. Investors who have 12-month horizon can consider short-term or corporate bond strategies. And of course, investors with more than 2-year investment horizon can consider income plus arbitrage strategy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.